So we're going to look at financial statement analysis. First of all, the methods, and then we're going to look at comparative basis, horizontal analysis, trends, and vertical analysis. So the methods of financial statement analysis are horizontal analysis. That's taking multi-period financial statements to calculate the absolute or the percentage changes in an item from one period to the next. So that's comparing items from, let's say, 1 year to the next or 1 quarter to the next. Vertical analysis is taking a single financial statement and each item is then expressed as a percentage of a certain total. So an example of that would be taking all income statement items and showing them as a percentage of sales. Finally, there's ratio analysis, which is an expression of relationships between two items in a financial statement. So for example, the relationship between revenue and assets. So the comparative basis are intracompany basis, that's comparison within the firm. You have intercompany basis, that's comparisons with other firms. So comparison with similar companies or firms. The thing that you have to make sure about is that the comparison is appropriate. You're comparing companies that are in similar industries where you can expect similar relationships, similar profitabilities, and things like that. And finally, there's industry averages. The comparisons are with other firms in the same industry, but as a group. So averages are being used. So horizontal analysis looks at trends in performance and strength over time. So percentage of change of net income from year to year, or all of the other items as well. So let's take an example here. You look at the balance sheet. So what we do is we calculate the absolute change. That's just the amount minus the previous year amount. So if you look at the cash, you've got 12,000 minus 23,500. That gives us negative 11,500, which means, of course, the amount of cash has been reduced or has gone down by 11,500 from 2010 to 2011. And the percentage change is just calculated by the change divided by the base year times 100. The base year, of course, is 2010. So we have 11,500 over 23,500 is minus 48.9%. Continuing with the remaining items, we're always comparing the change from 2010 to 2011, and the percentage is that change divided by the number in the figure in 2010. Now, performing the same exercise with the income statement, we have these numbers as shown. And here you can see an interesting relationship between the net sales and net income. As the horizontal analysis does show, the sales increased by 8.3% over the year, but the net income decreased by almost 22%. Now, if we look at some of the line items, we can see here that cost of goods sold and operating expenses increased by 14.3% and 2.1%. So the disproportionately larger increase in the cost of goods sold and some increase in operating expenses had caused the main decrease in income. So trends are also useful in analysis, and basically that's taking a look over a longer period of time. So in this example, you're provided with the main income statement data and requested to perform a trend analysis on Funnycorp. So here we have the numbers highlighted for 2010 and 2007. And with using 2007 as a base year and comparing that with the 2010 expenses as a data point, we see that the trend value is 1,966 divided by 1,701. So we have 116% of the base year value for 2010. So continuing with the remaining numbers, we come up with these results. Now, as you can see, our revenues have grown over the years to 132% of the base year, while the net income has grown disproportionately high by 313%. So it's shown a very good trend. We can graph also the trends. The graphic of the trend line provides a visual clue. as to how the profitability has developed. Here you can see how sales and expenses are very close to each other, but the sales outstrip the expenses, which gives us that incredible increase in profitability. Now, vertical analysis looks at intra-year relationships. That means relationships within a year or a period rather than over time. So as an example, on the income statement, we'd compare interest expense as a percentage of total revenues, or on the balance sheet, inventory as a percentage of total assets. Now, looking at the balance sheet below, using this example, I've highlighted now the cash values and the total assets, and the calculation is given as 82,000 for the amount of cash over 483,000 the total assets, which gives us 17%. And for 2010, we have 30,000 over 387, which gives us 7.8%, and we put it there. So this can be done with the liability side as well, using the same methodology. Here we see accounts payable of 76,000 divided by the total, which is 483,000. That gives us 15.7%. Now, as you can see with these numbers, the liability side of the balance sheet is relatively stable. These are the three liability numbers. And the equity has increased in terms of the retained earnings. But if we look at equity as a total, we've moved from, 67%, and we're about the same there. We're again at 67%. So the equity has increased in line with liabilities, the total amount of equity, and that's why as a percentage it's remained fairly constant. Thank you for your attention, and I hope that helped.